Morning, guys. It's Thursday, September 11th, 5:24 a.m. Central Time. Grain markets are mixed this morning. December corn futures up 1.25 at 418.25. November soybeans up 5.25 at 1030.5. December Chicago wheat unchanged at 515. December Kansas City wheat down 2 at 505. December spring wheat down 1 at 568.5. Mackenzie, I'm dying of a cold this morning.
I know that is no good at all.
My kids went back to school, and of course, when the kids go back to school,
Mm-hmm.
get sick. That's the way that this works. So you may have to carry the show this morning.
Oh, God help us.
Hey, so instead of doing farm economy type stuff, we're going to actually talk about the markets today. So we're going to get far less views this morning, and that's cool. Maybe the real crowd will be the actual viewers today. We've got a USDA report tomorrow.
So traders anticipate the USDA will trim its corn yield and production estimates, though both are still expected to set record highs. Soybean yield and production forecasts are also forecast to be reduced, but remain at record levels, while exports will likely be trimmed amid China's absence from the market. New crop U.S. corn, soybean, and wheat carryout projections are expected to decline slightly from last month, while global corn and soybean carryout estimates are seen edging lower, and wheat is forecast to rise.
All right. So general consensus among the trade, this is the Reuters survey, is that both the corn yield will come down versus last month, and the soybean yield will come down. USDA's methodology with regard to the yield estimates changes this month. In August, it was a combination of farmer surveys and satellite data. This month, they throw in they do another survey, which was late August, early September. And then they also use objective yield data where USDA goes out into the field and they actually look at the crops. And I would imagine that USDA is going to find a lot of the same things that they found on the crop tour. They're going to find disease pressure. They're going to find southern rust. They're going to find huge areas of the eastern corn belt that have seen massive rainfall deficits during the month of August. So I would think it's safe to say that the yield numbers come down, but not everybody thinks that. Of the groups surveyed by Reuters, there were two groups out of about, 15 that estimated an unchanged to higher corn yield versus last month. And there were five groups that are looking for a higher soybean yield versus last month, which, part of me wants to say, like, what the hell are you smoking? August was incredibly dry. How are they going to come up with the soybean yield? But I'll tell you, nobody knows anything. It's possible. USDA has tricked us and fooled us and surprised us with this sort of stuff before. So I'm not going to say that these people are crazy. Yeah, in my head, I think that, but I'm not going to say that. When you look at ending stocks, this is where things could get interesting in soybeans in particular. I'll tell you what, despite the woes of the export program, and we'll talk about that in a second, it's not as bad as you think it is. The United States soybean situation could get pretty damn tight, especially if they were to cut a couple bushels off the yield. And who's to say that they couldn't cut 3 or 4 bushels off the yield? USDA is at 53.6. What if that number ends up at 50? It's not a bad crop. And August was really dry. I don't know. I think you could make that argument. The corn carryout estimate, what's probably going to happen, if I had to guess, USDA is going to cut the yield, but they're also going to cut demand because I think they raised demand by too much last month. So they may very well settle in with a carryout number right around 2 billion bushels, even with some sort of yield cut. Wheat is still a pretty burdensome situation. So the report will be out tomorrow. We'll talk about it a little bit more tomorrow morning.
Argentina's corn production is expected to be record large this season. The Rosario Exchange estimates the crop at 61 million metric tons, assuming adequate rainfall. The exchange also boosted its outlook for the 24-25 corn crop to 50 million metric tons, up from last month's estimate of 48.5. Meanwhile, soybean acreage is expected to decline by 7% this season as farmers shift toward more profitable crops like corn. Soybean production is pegged at 47 million metric tons compared to 49.5 million metric tons last season. The Buenos Aires Grain Exchange also forecasts a reduction in soybean area, though more modest, at 4.3%.
We will use this opportunity to highlight Argentina as a producer and exporter of corn, soybeans, and the products. Let's look at some charts. Argentina is projected to be the world's fifth largest corn producer, 53 million metric tons. That's only 4% of global corn production. They matter, but they don't matter nearly as much as the United States or Brazil does when it comes to corn production. Corn exports, they export a larger percentage of their crop than we do. So they're going to account for, in all likelihood, 18% of corn exports this year. So they're competition on the export market, certainly when it comes to corn. Soybeans, Argentina would be the third largest global producer behind Brazil and the United States, projected to account for 11% of global production. They export very, very few soybeans, only 3% of projected global exports. What they do export are the products. What Argentina does is they crush a lot of the beans domestically, and then they export the meal. They're projected to be the world's top soybean meal exporter, 37% of all exports. Look at the United States is creeping up with regard to meal exports. It's oil exports I wanted to mention, where Argentina is also number one, but the U.S. is going to export next to nothing because we're using so much domestically for biofuels. So Argentina is some competition on the export market for corn, certainly. And when it comes to the products, their competition also. So if you ever see a news story that is specific to Argentina, whether it's weather or some sort of geopolitical stuff, you'll oftentimes see a move in the products more so than the actual soybean market.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
We do 20 questions with Matt Bennett twice a month. We take questions from our premium subscribers. Yesterday, Matt talked about his thoughts on yield potential. We had a lot of grain marketing specific questions. Like a lot of it was, what do I do with these unpriced bushels at harvest, and different versions of that. I've got basis contracts. I've got unpriced bushels. I need cash flow. Matt attempted, and I helped him to attempt to answer these very difficult questions. The crop insurance video we did with Ryan Bennis earlier this week is absolutely fantastic. I don't understand crop insurance very well. I mean, I know enough to be dangerous, but Ryan had some really fantastic graphics, probably the best stuff I've ever seen as it relates to the new programs, the MCO in particular, but also just your typical ECO, SEO, how they pair with and kind of complement the typical revenue protection. If you guys want to understand how this works, I told Ryan to explain it to me like I was a fifth grader, and he did a really good job of doing that. That was a really good video to watch. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tried to say anything else. We're totally independent guys. So what we do here is sponsored by the farmers and grain industry people that buy our premium subscription. We don't make any money off YouTube or off the podcast. This is a giant loser for us. So premium subs, we love you to death. If you are not a premium sub, I'll give that deal a shot this morning.
China continues to avoid new crop U.S. soybeans, relying instead on Brazilian supplies. The country has booked roughly 7.5 million metric tons of soybeans, mostly from Brazil, for October delivery, which covers about 95% of the country's monthly needs. At this time last year, China had booked between 12 and 13 million metric tons of U.S. beans for September through November delivery. While U.S. soybeans are currently 80 to 90 cents per bushel cheaper than Brazilian beans, China's 23% tariff adds $2 a bushel, making U.S. beans uncompetitive. Analysts estimate that if China stays out of the U.S. market until mid-November, American farmers could lose between 14 and 16 million metric tons of soybean sales. However, a trade deal could quickly shift the outlook, as China still needs to secure soybeans for November through January delivery.
I'm going to attempt to put a neutral to positive spin on this morning. Here's U.S. soybean exports annual. USDA is already projecting that soybean exports will decline by 9% this year. That's already baked into the balance sheet that traders are looking at. We have had other global buyers step up to the table and buy U.S. soybeans because of what Mackenzie just mentioned. U.S. soybeans are cheaper than Brazilian soybeans. China is avoiding U.S. soybeans because of the tariffs, and because of not so much because of the tariffs. They could waive the tariffs if they want, but they're making a point here against the Trump administration. They're making a point. They're fighting a trade war. They're not buying U.S. soybeans. That's what's going on. But USDA has already got this demand decline penciled in, and it's very early in the marketing year. But if you were to do any sort of version of pace analysis, the pace of U.S. soybean export sales is pretty close to what is needed to hit USDA projections, although it's very early. So it's premature to maybe jump to that conclusion, but so far we're doing okay relative to the reduced projection. Now, demand for U.S. soybeans in total, when you combine domestic and exports, is only going to be down like just slightly, very, very slightly versus last year. And that's because we're seeing this big expansion in domestic processing, which is the green bar, if you guys are watching here. So exports, going to be down, but domestic crush is the other big piece of the soybean demand puzzle for United States soybean growers, or soybeans grown in the United States, and that's going to improve. So the soybean demand situation is it's not bad. It could be a hell of a lot better if China was around, but it's not bad. And you guys saw the carryout estimates that people are looking for. We're looking for a sub 300 million bushel U.S. carryout to be printed in USDA's report tomorrow, and that's not a super bearish item by any stretch of the imagination.
Uncertainty over President Trump's biofuel policy sent biofuel shares plunging on Wednesday. Shares of U.S. biofuel companies tumbled amid concerns that the Trump administration's latest plans won't fully make up for refinery exemptions from federal blending mandates. The administration is weighing a policy that would make large refiners absorb half or even less of the blending obligations originally assigned to small refineries that received waivers. Adding to the uncertainty, Senator Mike Lee introduced a bill this week to prevent the EPA from shifting those requirements onto bigger refineries. Fears of weaker near-term biofuel demand drove shares of Bunge, ADM, Valero, and Green Plains lower, while pushing biofuel credit prices to their lowest level since June.
Okay, so this is kind of complicated. I emailed Pete yesterday and I asked him about this, and this is what I said. I said, Pete, explain this quote to me. This would require large refiners to cover a range of about 50% or less of the 1.1 billion gallons of the renewable fuels exempted last month for small plants, according to sources. And then I asked him this: why do the refiners need to cover the gallons at all if they were already exempted? Pete replied, he said this: that's one of life's great mysteries, to be honest. You would have thought what's gone is gone, but that's not the case, actually. The exemption does remove the number of gallons from the mandate, but in order to maintain the overall volume requirement, the shortfall is allocated to larger refineries. This is the inequity in the RFS and something that irritates both large refiners and pro-ethanol groups. Most large refineries have enough RINs through discretionary blending to cover the shortfall, but they argue the small refineries should have to buy them rather than be exempted. I don't think this is going to happen. If it does happen, Trump's going to have a very tough time getting his budget passed. And it would be a very bad look, given that, as I mentioned yesterday, I think the Trump administration is kind of already skating on thin ice with the ag lobby, which is tied to the ethanol lobby, very similar.
U.S. ethanol production increased last week. Weekly output rose to 1.1 million barrels per day, marking the highest level for the week in the past decade. Production was up 2.8% compared to the prior week and up 4.1% versus the same week last year. Ethanol stocks increased to 22.8 million barrels. The print was up 1.2% compared to the previous week, but down 2.2% compared to the same week last year. According to Reuters data, U.S. ethanol production margins remain strong.
Yeah, margins are great. According to the Reuters stuff, anywhere from 20 cents to 60 cents per gallon positive when you're looking at only spot prices of corn DDGs input. Different plants, of course, do things differently, but that's a fantastic print. And the stocks, I guess, are kind of where we need them to be. You'd always like to see them a little bit lower for the sake of the market, but they're not excessively high like they were a couple months ago. So all is good here in the ethanol space for the time being. What did cattle do yesterday?
Cattle futures were mixed. Live cattle were 45 cents to $1.67 higher. Feeders were $1.77 lower to $1.50 higher. Box beef prices were lower. Choice was down 203 at 405.64, and Select was down 328 at 383.68.
Dow Jones is up 80 points. The S&P is up 12. The stock market's been very strong because everybody is basically has been guaranteed that the Fed's going to cut rates here. I believe that's next week on the 17th. Bonds are off just a little bit. Treasuries off a little bit. U.S. dollars up. Crude oil is down 50 cents in the October WTI, 63.14 last trade. Have a great day, guys. We'll be back on Friday.